Hey guys, a little pullback today. So it's been the running of the bulls lately, hasn't it? Just everything just going bananas. We're seeing parabolas everywhere. Just a reminder, everyone, of the disclaimer. So that anything we talk about today is for educational, entertainment, and information purposes only. And it started to make me a little bit nervous. I'll show you implied vol versus realized vol in a moment. But this weekend, I started to post a little bit about how this was making me uncomfortable. Short-term volatility risk premium is widening, reminiscent of early July. Let me show you what that means. Okay, so when you look at volatility, you can look at basically two kinds of volatility. One is implied volatility, which is option pricing, right? So whatever you see on the board, calls, puts are worth whatever they are, that is an implied move going forward. So that is looking into the future. It is an estimate. It's more of a guesstimate based on what's going on now, what's happened in the past, and what may happen in the future. And so people are pricing risk going forward, and that's how they price options. Supply and demand basically determines that. Realized volatility, however, also called historical volatility, is actual volatility. That's what's happened in the past. It's set in stone. It has happened, it's occurred, it's in the past at this point. And the two kind of work together because risk should respect, to some extent, should respect the underlying rather the implied volatility option pricing should respect the underlying risk, right? The price of car insurance should be somehow related to the underlying risk to the insurer, to the underwriter, right? They can't be completely disconnected. They can't charge $1 million for car insurance when their average claim is $1,000 or $5,000. There has to be some connection. And that is indeed how option markets work. There's some connection to the underlying risk, which is why options on Tesla are much more expensive than options on Johnson & Johnson, for example, because the options on Tesla have to reflect the underlying risk of a stock that's much, much more volatile. In the case of Tesla, it can go up $50, it can go down $50, whereas a calm stock isn't necessarily going to do those kinds of things. So the option pricing relates to the underlying risk. So what does that mean? When implied volatility is higher than realized in blue here, so the green is higher than blue, that means there is a volatility risk premium. We call that a carry as well. There's an excess of option value versus the underlying risk. And lately we've really seen that widen a little bit. So here's your implied volatility option pricing and your realized volatility plunging. Look at this 5-day vol at 492. So let's go back in history here. How does that look? Well, here's under 5, here's under 5, here's under 5, here's another one, there's another one, a bunch more here. Well, guess what happens? The underlying movement can get really, really, really quiet, but after a while it bounces back, right? And in fact, it doesn't take very long. So the realized volatility bounces back, bounces back, bounces back, bounces back, bounces back, here, 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 here. So I said on the weekend, I said, this can't really continue. Something's got to happen here, right? Either stocks are going to come off or they're going to explode higher, which can also push up implied volatility as well. So I said, there were a number of signs of complacency, put call ratio falling off an absolute cliff. Let's take a look for that. So here it is. Here's your put call ratio, literally falling off a cliff. I mean, we're back to sort of the 2021 levels here. And let's take a look at our volatility risk premium right here as stock goes up. So volatility risk premium on its own isn't that concerning to me, right? That's a reality. That's why option selling is often not a bad way to go, because you have this excess in value of options over the underlying risk, right? And so we're trying to capture that volatility risk premium. It often exists in puts more than it does in calls. I did a great video on that about a month ago, which was really well received because I think it made people understand that there's a real difference there. You have to be very careful when selling covered calls. But this put call ratio coincides with, look at this, the consumer board conference, consumer sentiment confidence. Look at this. Look at this. This has gone parabolic in terms of the percentage of people who think stocks are going to go up. I mean, if you've ever seen, too many people on one side of the boat, this is what it looks like. Look at that. I mean, it's absolutely straight up incredible what's going on there. Here's the cost to insure. People are literally, like, kind of the first half of the year, people are throwing out puts now. They have no interest. Here's the cost to ensure 1 month insurance in the S&P is has only been this low about 3 times in the last 3 decades, right? So we had a little bit in the last part of the previous decade, which was, of course, the QE era of just continue, very, very low volatility, low implied volatilities, compression of vol because of that Fed put. And then again, kind of ahead of the global financial crisis. So here we are again, the third time that people are assigning an extremely low value to short-term puts. Now, I wouldn't go overboard on something like this. It's definitely eye-popping, but remember, it's only a 1 month measure. So we could look out 1 month now and, probably nothing much is going to happen until January, but still surprising to see something like that. And so we've really had volatility just in the span of just a couple of months. Remember that high VIX, high concern level that we had before the election, and then a little bit into NVIDIA as well. But that MOVE index, which is rates volatility, was extremely high. It even put the VIX to shame. It was so high. And we've gone from this way up here above the 90th percentile across the term structure to way down here, everything being extremely, extremely, extremely cheap. And this one just shocks me. Look at this. Everyone expects stocks to go up. That, to me, there's some concern there. So look at this. Since election day, look at how people have plowed money into the US. It is absolutely incredible, out of everything else and into the US. And you could understand that to some extent. These stocks are just the place to be. The US has all the great companies, almost all of them, save for a few in the top 10. Just incredible profit potential, leading in digital in so many ways. But still, look at this, so much money plowing into there. Now, does this mean it's a bubble? Probably not. You look at a name like Meta trading at 25 times forward earnings. That's not a bubble, right? That's why I've been loving that name for the last $150. Because it's one of my favorite names. So you have tech companies out there that are just knocking it out of the park, and they account for so much of profits in the S&P 500. So you cannot ignore that fact. But there is some exuberance going on, right? We're just going to have to figure out where are we in that exuberance cycle, right? In the sort of 1990s Alan Greenspan, are we, 1996? Are we 1999? Or where are we in that? Look at this. U.S. equity saw a whopping 141 billion worth of inflows over the last few weeks, the largest monthly inflows on record. Just incredible. Authorizations for corporate buybacks, 1.14 trillion. So that's up 17% what was authorized last year. And so Goldman Sachs is forecasting 1.07 trillion worth of buybacks in 2025. Just gigantic, right? And so let's talk a little bit about gamma here. So we had this pullback finally. We pushed 6,100 last week, which was a little further than I thought it would go. Listen, I've been saying since forever, we're going to push into that 60-50, 60-55 collar level. And we did, and we pushed through there almost like a knife through hot butter. Like, it was a little bit surprising how little resistance there was above that, where you're supposed to have this big amount of gamma that means it's supplying market with lots of stock. You've got all these market makers who have massive positions who are just hammering the market. Plus you've got other people coming in and smashing vol over the last few weeks after the election, knowing that we're heading into Christmas and the holidays and all the big news is out of the way, the election, the NVIDIA earnings, everything. So people have been smashing that vol, and you can bet they are absolutely getting hammered with zero DTE as well. So dealers are getting hammered with calls, and what they need to do is sell and hedge market against stocks, futures, whatever. They need to sell the market against that. And so we got up to that 60-90, and then I think it was just, there was too much gravity from that 60-55 level, right? So we've got this massive column of gamma at the 60-55 level where those calls are, and then all these other option positions that I'm telling you they're getting slammed with. That creates a lot of pressure on the way down, and today it finally gave way a little bit. Part of that is also, not to get into it too deeply, part of that is probably a little bit of charm, right? So charm is one of those Greeks that you're not going to hear too much about, but it's basically the effect of time on delta, right? So if you have lots of in the money calls, as time goes on, as you get closer to expiry, those deltas are going to go up on those in the money options, whether it's a put or a call. In this case, let's say it's a call. that gets stronger. So that means they have to hedge even more. So the passing of time makes them sell more. Dropping of volatility, which is Vanna, is going to make them sell more. But we kind of had the Vanna kind of happened already over the last couple of weeks. That's sort of out of the way. Now the charm is going to have an effect. So my prediction is that we're really probably going to hold pretty steady around that 60-25 level, and then probably do a little bit of what we did last time, which is kind of pin around maybe 60-55, anywhere between 60-25 and 60-90, I think is where we're just going to kind of drift around a little bit. So I'm liking a lot of short vol positions into this. Let's take another look here at some of the other things that are having an effect. Derivatives income fund growth. Look at this from 2020. Absolutely massive creation in AUM, in funds that use options. Here is isolating the embedded option selling strategy. So these are ETFs that just sell options, right? Cover call ETFs, things like that. And they've absolutely exploded. That is more gamma for the dealers. That creates more of a clamp on volatility. That reduces volatility over time when they have those positions. So let's take a look at what happened today. We've got Tesla. We've been calling for 400. 100% in the I posted this last week. We've been shouting out 400 in Tesla. Nobody believed me. Well, some people believe me, but look at this 9 EMA that we've respected. Look at this, blasts out through this big resistance here, smokes through that resistance, and comes back to that 9 EMA, bounces up again, makes another effort, collapses, goes through that 9 EMA, recaptures it, touches it again, and then takes off a few days ago. Today we got over 400 and we pulled back, and around 380, I hammered out some puts, shorter term puts. I'm thinking that we hold, right? So that's predicated on this idea that there's just incredible strength behind Tesla and that it wants to get to this level, which is the previous high. Here's your Tesla weekly. I think it can get up there, right? You've got this incredibly strong MACD. You have this incredibly strong breakout. It's starting to stretch pretty far from that 9 EMA, that weekly EMA. So, maybe it struggles a little bit, but it certainly hasn't shown much evidence of struggle. And I think there's a very good chance we get up here. So I think we get there. We'll have to see if we need the market to support that a little bit. Here's Microsoft. It was kind of lagging all the other mags for a little while. Now has finally started to push through again. And in fact, today was up even in the face of kind of a rough tape. So I like that one too. I think that can probably over the next couple months get right back to those old highs again. Let's take a look at Meta, one of my favorites. Beautiful, beautiful stock, blasting out through this resistance here. And then today, just kind of pulling back a little bit. That's another one that we hammered out some puts on, right? Think about, like, especially in a market that's a little bit squishy, you want to make sure you are doing that in the best names. There's still no guarantees on anything, but if you end up owning one of these stocks, make sure it's one that you absolutely love. Here's Amazon, another one. We've played this. I'm going to do another video on this. We've played it like a Stradivarius. I mean, we've been putting on these turbocharged plays over and over again, grabbing all of these moves. We got out at 220, so we haven't grabbed the last sort of $7 to $10 of this. But again, today started to pull back a little bit. I'd like to see Amazon, as it often does, pull back $10 to $15 after it makes a big high again, maybe down into that 215, 217 level. I'd like to see that in order to maybe pick up another either turbo play or maybe just sell some puts. If it happens soon, I'd probably just go with the puts because I don't want to get too. I'd like to have a little bit of a lean towards theta accumulation, right? In this kind of holiday environment. Here's one that I've been staying away from. We were in Nvidia and I got out. I just said, I do not trust this particular stock. I don't know what's going on. It didn't knock it quite out of the park enough. Semiconductors in general have been poor. Look at the AMD chart today. I don't have it here, but it looks like hell. It's back to August levels. So there's something going on in the semiconductor area. Broadcom's acting okay. ASML, we have a position on, but it's bouncing back, right? It's $100 above our short strikes. And that's more of a recovery play. But in terms of the leaders in those sectors, some of them are really struggling. And look at Nvidia get right back here. And I said last week, I'd like to see this thing above 147 or so, and we didn't get there. So here we are. I'm definitely skeptical of the semiconductors for now. Here's Reddit, one of my favorites. I got everybody into the community, well, whoever picked up the trade, got people into the community around 114. We did some covered calls. It's going to be a good trade. Could have been better, but we've sold puts all the way up. And again today, we hit 180. We pulled all the way back to the mid 150s or high 150s, and I hammered out some puts. The put values are quite high right now because of this parabolic move that we're having. But I'm not 100% sold on this. I am for the long term. I definitely think this is a $200 stock, but I'm not sold short term because we're starting to see some parabolic moves kind of keel over a little bit. So, I think we just have to respect that we've had some crazy, crazy moves to the upside. And there's the potential for that to reverse a little bit. Here's TLT. I like what I'm seeing here. It pulled back a little bit. That's okay. We can see that this 20-day is crossing the 50 very, very soon. I think that's very, very positive. We've got everything above the 200-day. I don't think long-term does as well as short-term bonds, just because I think there's some challenges at the long end. Which is a conversation for another day. But I do want to see TLT kind of remain above 90, 91 in order for my warm porridge sort of scenario to play out in that roaring 20s scenario. I'd like to see everything do well, right? We saw a little bit of that today. We saw IWM outperform growth. We saw growth squishy. IWM was outperforming for much of the day, finally succumbed at the end of the day as they started to sell everything. But we did see that broadening happen again. So in my view, there could be this continual sort of hopscotch being played, right? It's growth, and then it's broader, then it's growth, then it's broader, cyclical, secular, cyclical, secular, and this game is played, right? But in the right kind of rate environment, I think they are going to lower rates a little bit, maybe not crazy amounts, but they're going to lower rates a little bit, and that really sets us up for a potential explosion to the upside again. Here's the Russell 2000 pulled back to 237, right? We were very strong all day up around 240. We are long Russell from about 214, which is great. We're doing well. We've got some cover calls at the 240 level in December, so I'm perfectly fine with this. I'm going to let that bake off. We've got a lot of cash secured puts, a lot of covered calls. We're going to let those bake off. We had some great positions in BABA today that are going to get challenged a little bit on the covered calls, but we have some uncovered as well. So we're in the China trade. We're looking for that to get back. We're also looking at some metals. Freeport McMoran looking a little bit interesting with that China bump. I'm skeptical of China, right? So I don't want to jump in with both feet, but we saw silver jump today. That's helping our position there. XLE being challenged, however, so we do have a dud on the XLE that is going to have to be managed a little bit. I love those names, cash flow, amazing cash flow companies, but we're going to have to manage that position a little bit. It's by no means in huge trouble. It's sitting right near the strike, so it'll be fine, a little bit lower than the strike. But I think I think in general, I think it's okay to own those names, especially if they start to kind of cycle a little bit out of these high flying mag stocks and into some sort of broader economy sort of names. Here's MAGS, which is the Roundhill Big Tech ETF. So look at this smashing through this sort of almost pennant and making these highs. Actually didn't do too bad today. Considering the market pulled back, it came off the lows, and that's because Apple and Microsoft were super, super strong, and really Amazon didn't do too badly at all. So MAG by no means is out of the picture. So we're definitely going to watch that. Unless I'd like to see this maybe keel over a little bit, that to me would compel me to push me into sort of a little bit more broader economy stuff. Right now, MAG is really, really leading. I think a lot of managers are not need to top up their positions. That's what's happening out there for those uncomfortable positions they're going to have with clients if they don't own Microsoft, Nvidia, Amazon, Apple. If they don't own those are uncomfortable conversations. So they want to avoid that. So always think about how those advisors think about things, and you'll get this game a lot better. So hopefully that helps you guys, and we'll see you in the next video.